Hey, thanks guys for taking the time out to be on our webinar today. We've got an interesting concept we want to tell you about. It's something that we've actually been talking about in the past on some prior webinars. But today we've got Jeffrey Sanders from Northstar Funding Partners with us. We're going to talk about their platform, and it's called the Insured Retirement Advantage. And basically what this is, it's a small case design premium finance plan where we can work with you and your clients to help finance the premium on their IUL policies. Now, it's not ever for everybody. It's not really a cookie cutter approach, but in the past, premium financing, it's been reserved for the ultra wealthy. Your clients with a minimum of 5 to 10 million of net worth. They've got the ability to navigate the complex lending structures, and there's substantial financial underwriting that goes along with that. Well, Jeffrey's going to tell us about Northstar's plan called the Insured Retirement Advantage, or as it's coined, the new IRA. And we're going to talk a little bit about how you would qualify for that. We're going to show a case. It's not a live case, but it's an example of how this works. But there's three things that make this plan possible for middle market America out there, your high net worth people that just aren't thinking in this way. Number one is simplified access. There's no tranches that you got to deal with like some other plans that are out there. There is a one-time financial underwriting. Competitive terms. It's just a 1.85% spread over the benchmark rate that you're going to see out there. And then flexible qualifications. Your clients up to age 60 can qualify. There are relaxed financial underwriting. Typically, you're going to see, and this ranges from carrier, but income requirements around, anywhere from 100 to 200,000. So, if you're an agent and you're working in the IUL space and you're finding it hard to get in front of more prospects, more business owners, more wealthy individuals, this is really something that you're going to find nobody's talking about. Not a lot of people are talking about it. So if you can get your elevator pitch right and your talking points right, then you're going to be able to get a lot more appointments with the new IRA platform than you were just trying to get appointments for an IUL. So with that, Jeffrey Sanders is going to tell us more about the Insured Retirement Advantage. Jeffrey's been in this business for over 35 years. He's been doing these case designs for over 12 years. So he's very knowledgeable on how these plans work. He's actually not just a case designer, but he's done a lot of these cases. He has clients today. So with that said, and we're going to get this replay out to everyone. So don't worry if you want to have the replay to skip around on, but let us know. Be thinking of some people that this might work for. Give me a call. We'll get you some proposals, and then that way you'll be able to take that out and work it with your clients. But Jeffrey, I'm going to hand it over to you. Tell us, a little bit about yourself, and then a little bit about how the plan came about, and then let's talk about the plan. So we appreciate you doing this for us today.
No problem, Doug. I'm always here to help you out. You've always been good to work with. So, as Doug said, I'm not trying to give up my age or anything, but I have been doing this for quite some time. I started as a registered rep back in 1992, still am. Work with a handful of families just at that end. Really took a liking to this. Northstar. Been associated with Northstar, founder Kim Coulter, for the entire 35 years in one way, shape, or form. We travel extensively, we socialize extensively, and we do business extensively. Northstar Funding Partners does nothing else but premium finance cases. You can't come to us to be an agent. You can't come to us and ask us for advice on annuities or different insurance products that you're not financing. This is all we do. We're going on just about 25 years. We gave everything else up in order to let the Doug Mitchells of the world, mom and pop shops, big shops, whatever, let us in because they know we're not going after their agents. So let's get this part out of the way. We have a traditional platform like everyone else. I do believe ours is superior. We do tend to have the most accurate numbers out there, and we can talk about that on another call. That's leading into this platform, otherwise known as the Insured Retirement Advantage, the new IRA, or what we simply also call the small case platform. It doesn't mean that they're small cases only. It's just what we refer to it as. This platform is not owned by a bank. It is a registered trademark. It's a proprietary software to run it, and it's Northstar's. We own it. Okay? Why did we develop it? Because we wanted Doug and all of his people not to have a bigger pond to fish in, but to have a vast ocean to fish in. Well, how do you do that? You do away, as best as possible, with the need for additional collateral. Okay, because on traditional cases, there's what's called a shortfall most times, meaning that the outstanding loan value exceeds the cash surrender value for a period of time, and understanding that every bank in this space is fully collateralized from day one. Your first line of collateralization is the cash surrender value. Well, in order to be able to apply for a traditional case, the individual must have a net worth of at least $5 million. When I say at least, because some banks are 7.5, some are as much as 10 million. And that's because they want to make sure that individual has the means to post additional collateral. So what we did is we came up with a plan where we try and negate, and so far very successfully for all these years, the need for additional collateral. And we're going to get into that in just one moment. I'm going to bring us down here first, and you'll be able to look through all this, but I want to bring you down to some of the bullets as far as what would make somebody be able to apply for something like this. And let's bring that page up. The bullets, as I call it. Okay, here's the details. The minimum initial face amount of $500,000. There is no maximum, depending, again, on the net worth. If someone is applicable for this, which is bullet at the top on the right-hand side, it is not net worth, it's income. If they make between $100,000 and $200,000 for the two most recent years in a row, they can be applicable for this. Don't get me wrong. If you bring me a doctor who made $350,000 last year and is making $350,000 this year, but only has $4,200 in the bank, obviously that person's not applicable. They have to have some means. Well, what about, next bullet down right here on the right side, what about the guy who owns a company and he makes widgets? And his company basically pays for everything, and he only draws a $45,000 a year salary. Well, if his business does $750,000 in gross revenue, not net, for the two most consecutive years in a row, this person can also be applicable. Okay? We're going to skip back over to the left side here. Second bullet down. How much will the bank loan? They will loan no less than $50,000 each year for the loan. And when we send these out, they're 10 pays. So it's $50,000 a year. The bank is loaning for each of the 10 years. Okay, we will talk about in a moment when we get to the quick view, the next page, the client's contribution or out of pocket. Okay, this has a maximum age of 60. There is no minimum age, meaning 18 and over. We do have some carriers that have made exceptions that your upline can go to them with for somebody who's maybe in their early mid-60s. So let's jump ahead now to the quick view. Okay, this tells the story. Okay, again, we call it a quick view. Unlike others, and I'm not going to necessarily throw stones at anybody else's plan. That's just not the way I work. I'm going to tell you about ours. Okay, unlike others, the out-of-pocket, which is right here in the middle, the client contribution, does not represent any premium whatsoever. In this case, this premium is $83,000. That is all lent by the bank, and we'll get into what the client contribution represents in just a moment. Okay, the minimum out of pocket as of right now that a client can contribute is $30,000 a year. And I say as of right now, that's because of where interest rates are. As interest rates start to come back down, they can be contributing as little as $25,000. So we could have a premium of $50,000 is the minimum, with an out-of-pocket, which will be, again, in the near future, I believe, $25,000. It is $30,000 right now. And just mathematically, that's how it works out to be one of the cogs in the wheel, if you will, to lead us to columns 3 and 4 from the right side, which is your estimated collateral calculation for any collateral that has to be put up, or the estimated collateral range. Okay? You'll notice they're all zeros, though. So let's get back to over here, the bank, and the second column from the left, the $83,000. Well, $83,000 may or may not be a lot of money to any of you out there listening, or to me, or to Doug. But it doesn't matter to the bank. It's not a lot of money to them. The bank wants to deploy more than $83,000. Okay, so they want to deploy 4.5 years of the $83,000. They can only use 1 year's worth for the first policy premium. Otherwise, they would overfund and mech the policy. So they take the other 3.5 years and they put it, next column over, in a DDA account, a direct deposit account, in the borrower's name at the bank. In other words, it's a bank account. And if you take note, do the math, they're taking $83,000 a year out and paying the second year premium, the third year, because this is how much is in the DDA account at the end of each year. So at the end of year 4, going into year 5, there's only a half a year's worth. They add the other half, send it off to the insurance company, and then they simply directly pay for the insurance year 6 through 10. The DDA account is closed and no longer needed. Now, what's the benefit to the bank? Very simple. They're charging interest on all that money from day 1. Okay? So that's why, let's go to the next column, projected end-of-year loan balance. That's why when a client looks at you and says, wait a minute, I borrowed $83,000 in year 1. Why do I owe $397+? Well, I just explained, and I explained why it's a benefit to the bank. Let's go to the client, though, because that's who we really work for. And that's who we want to make sure is happy. What is the benefit to the client? I believe you will agree with me once I explain this, that the benefit is actually greater to the client than it is to the bank. Let's go all the way over here. Fifth column from the right. This is your illustrated life policy low point cash surrender value for each year. Well, when we went to the bank all those years ago and presented this, what is the bank's job to do? Their job was to shoot arrows at it and see if they can pierce it and make a hole. They don't want to put something out there that they can't live by. Okay, so if you look, let's just jump to end of year 2. They owe $370,000 plus dollars. They only have $346,319. The bank said this is not going to work. There's going to be a collateral call. Client has to have a $5 million net worth. And we said, well, if that happens, what are you going to do? And they said, well, we're going to close out the policy, the cash surrender value, because it's ours. It's been assigned to us. And then we're going to send out probably somewhat of a nasty letter asking for the difference to be paid that the client is responsible for. We went back to column number 3 right here, the DDA account at the end of year 2. And we're like, well, there's still quite a bit of money in the DDA account. What are you going to do with that money? And he said, well, we'll claw it back. We'll take it back. And we said, but in essence, actually in reality, isn't that the client's money? Meaning you're not sending them that money because you want to make sure it's going to pay premiums every year and they're not going to go out and buy some expensive, flashy car with that money. And they agreed with us. And we said, and in reality, it's their money because they're getting charged interest from day 1. They looked at us at the bank and said, you know what? You people are correct. That is why we go back to this column, which is the cash surrender value column, and we had to add this little right here, plus. So it's illustrated life policy low points values plus DDA account. So when you add up what's in the DDA account to the cash surrender value, there is more than enough money there. If you look at the 5th year, they owe $316,529, which we're going to get to. Why do they owe less by the 5th year than they did in the 1st in a moment? But you'll see they have over $352,000. What I'm trying to express is that by the end of the 5th year, this loan is extremely controlled. Okay, so why is it, though? They borrowed $397, but at the end of year 2, they only owe $370, and then they're only $338. Here's where we get into the client's out-of-pocket, as we call it, otherwise known as a client contribution. Okay, here is our interest rate each year. The interest rate is based on CMT, plus, as Doug mentioned, a spread of 1.85. The spread remains constant through the life of the loan. It never changes. The only reason the interest rate will change that they're being charged each year, up or down, depends on where CMT is on that given renewable time. Okay? With a floor, we always have to use whatever the bank's floor is. In this case, it's 5%. Okay. So what do they do with this $50,000? Well, let's look at year 2. We'll get to year 1 in a moment. In year 2, they owe $20,297 in interest. So the first thing this $50,000 does is pay off that interest in full, so it's not rolling into the loan. Well, unlike some other banks where basically what happens to the rest of that $50,000 it kind of just vanishes, this bank actually uses it towards the client's benefit. They partially amortize the loan. They use the difference to lower the value of the balance owed back to the bank. And that is why for the first number of years, you actually see the loan balance going down, not up. Because again, $50,000, we wipe out the interest in full each year and then partially amortize or pay down the loan. That's what's done during years 2 through 5. Year 1 pays the interest in full, but the difference is put aside for lack of saying it any other way, to partially collateralize the loan. In other words, they take a little bit out of that remaining, let's just round it in this case to $20,000+ towards, you have to be careful because that's not collateral that gets returned. It's not posted. It's actually paid. I like to be very transparent and have everybody understand where the money goes. So again, year one is a partial collateralization and a full payment of the interest. Years 2 through 5, again, those years are a full payment of each year's worth of interest and then a partial amortization. By year 5, I've already shown you the loan is very well controlled compared to what we have. So now what if someone pays 10 years out of pocket? What does that money represent? Well, once again, it covers the interest charge, so it's not rolling back into the loan, but rather than necessarily amortizing the loan, for lack of calling it anything else, it bolsters the cash surrender value. So let me make myself clear. This can be done, again, depending on someone's age. A little more difficult if someone's in the older realm, if you will, but it can be done with only a 5-year out of pocket. Again, it's a 10-year payment schedule for premiums, but this could be run with only 5 years. Well, why would someone pay 10 if they can only pay 5? Remembering that first 5 years, those are very essential years to once again control the loan. Okay, the reason some clients like to pay more than just 5 years, be it 7 years, 8, not 10, is because it will create a greater projected income stream, okay? And this is why people will pay because, again, their income stream will be, now, it won't be double, but it will be somewhere between 30 and 40, so we can average around 35% higher than if they simply paid the 5 years out of pocket. Okay, so what every carrier always wants to see is an ending to the loan being outstanding. So every design, we have to show what is referred to right there as a projected payoff. Now, unlike others out there, as Doug mentioned, we do not use tranches. We fund often because we fund individually. We basically fund cases every business day of the week. And by the way, while we're talking about that, let me mention that's when you fund a case through us, your first year, you're not ending your relationship after it's funded that first year. We actually manage the loan for its life, no matter how long it's funded for. These loans could be paid off as early as 12 years or as late as the 20th year. Even if the client was to sign this on a dotted line, in this example showing year 15 projected payoff, they're not obligated to that. They can change their mind. The client is in control. They could say in year 12, you know what, I want to pay it off now, or I don't want to pay it in year 15. Let it be out there a little bit longer, building up some more steam. Because remember, this is coming out of right here, the cash surrender value. That's why you see this drop from 1.2 to 600,000. Okay? So now, that being said, the client also later on, not now, they're not bound to having to borrow that money out of their policy. Okay? They can pay it either fully or partially with outside funds. Meaning, if they sold their business, maybe they had a good hit in the stock market and had a big rise, why would someone want to pay it with outside funds either partially or fully? Because they would be paying it with after-tax dollars. Therefore, they're leaving a lot more money in the cash surrender value. Therefore, they can take a higher income stream, and that income stream is 100% tax-free. And that's why someone can decide that as things might change in their financial standings as they get older. Again, like I said, they might have sold a piece of property, a business, did well in the stock market, but they're not bound to having to pay it out of the policy. That being said, anytime we do borrow money out of the policy, be it to pay the loan, be it for income purposes, you always make sure we're going to do that in the form of a participating loan. And Doug can get into that with you. I can always get into that with you, but we always want to make it participating loans, so all monies, even money borrowed out, participates in all gains in the future. Okay. That's, I know this is a lot to absorb in one conversation, but that's pretty much it in a nutshell. I know there will be numbers of questions. Doug has all of my contact information. I will always make myself available to set up a time to have a call with any of you, with Doug or without Doug, individually, or groups of you, however you'd like to do it. This just shows you, and then we're always showing that we're endorsing you. Your name and information would appear here on the last page, and that's who we're always showing. And there's going to be pages showing the different contributions and so on and so forth. But again, this page right here, otherwise known as the quick view, this is the most important page. Unlike some others out there, and I never say competitors because I don't feel anybody can actually compete with us. And yeah, I'm giving Northstar a big pat on the back. But unlike others out there, you will also get a carrier illustration with this design, so you can see how we did it and how everything matches up. A lot of others out there just send you their design, but you get no carrier illustration and sit there and twiddle your thumbs wondering how did they reach these numbers? How did they get there? So that's where we are. Northstar, like I said, we've been doing this an awfully long time. I am in South Florida, so I'm East Coast time, even though on my emails, when you start to see them, it's going to say Arizona. That's the home office is in Arizona. And then we also have Pat as Central Time. So we basically have almost every time zone covered. I want you to understand, everybody has a specific job or a couple jobs. Mine is to do nothing but these phone calls, individual calls, presentations to the agents, and designs. I do nothing administratively. If I did, I'd never be able to have time to do a phone call like this. So we have a whole other team. And again, that team is spread out. There's Pam and Stephanie in Arizona. There's Anne-Marie here in Florida. So we've basically got everything running smoothly. Like I said, we've been doing this for quite some time, and we don't do anything else, not a single thing. Let me see if I could bring up now when Doug's going to share with you when you are ready to submit a request. You can always call us and discuss it with us, but we don't take requests over the phone. Do you see the suitability, Doug? Did it just pop up?
Yes. Yeah, it's showing.
Okay. All right, guys and girls, this is it. We make this as simple as possible, not only for you, but for us. It's a 2-page form. I'll go through it very quickly. At the top of the page is going to be your information, Mr. or Mrs. Advisor, including, Doug's upline, so on and so forth, your preferred phone number, what state you're in, and so on. Next down, I know this is going to be Insurance 101, but I almost beg of you to please give us a name for your client. We don't care. We're not contacting the client, but you have no idea how many valued male 45-year-olds I run, and then all of a sudden the agent, with or without Doug, is contacting me saying, hey, remember that case you ran, 6 weeks ago? I think we're going to get, green light to go. But I'll never find that case because I have too many of them. So I put it in a subfile under the agent's name, and the subfile for the agent is under Doug's name, and I can pull it up very easily. Try not to, I ask you all, again, Insurance 101, try to give me a date of birth, not an age just. You have no idea. Let's go back to that agent who's calling me 6 weeks later. Hey, my client gave me the green light and we're ready to go. Da, 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 da. Oh, by the way, they had a birthday 10 days ago. Oh, that's going to change the design. Okay, so it's better if we have, a date of birth right away. And then these little boxes that a lot of people tend to miss, just make sure you check off. By the way, you can print this, handwrite it, scan it in and send it, or it is fillable on the computer. Obviously, if it's a second to die, you're going to put the second person's name. Let's skip down to the middle of this page right here, all the financials. I'm going to tell you right now, don't put the cart before the horse. We don't need all those financials just yet, okay? What we do need here is approximate net worth and approximate income level. Those are the two most important things. Skipping down to the proposed life insurance policy, planning objective, purpose of insurance. It's very simple. You can simply write income or estate planning, okay? It's as simple as that. Most of these cases, most of these small case platforms are income driven, okay? So most of them you will skip the initial face amount. Obviously, if you have a client that says, I just want to make sure I leave my kids and my wife or whatever $5 million, that's for estate planning, then yeah, just put the face amount in there. Your preferred carrier, skipping to page 2, please put state of issue. I'm not going to always assume that it's a client that lives in a state where you are located. I've had to do that in the past, and it doesn't always work out that way. The source of gap collateral, like it says in the parentheses, if it's an IRA case, you don't need it. We're looking to avoid needing collateral, and I can go into that in individual conversations, not to make myself sound too long-winded already, as to how a collateral call can occur. We've been able to avoid it, though, thus far. Okay. Proposed financing arrangement, if known at this point. A loan in this space is never made to an individual. Depending on the bank, they will give you choices of who the loan could be made to. The bank we use for this platform is very broad. You could basically make the loan to any entity you can think of. It could be a trust, revocable or irrevocable. It could be any type of corporation. It can even be an LLC. It can even be an LLC that's developed for nothing else but this transaction. So that, again, will be up to your client, maybe their accounting advisor, and so on. That's it. Then you're going to see down here, each of the 4 of us who run designs, Brock and Garrett are both in Arizona, so depending on the time of year, they're anywhere from 2 to 3 hours behind me. Pat is Central Time. He's in Texas. And like I said, I'm Jeffrey right here, and I'm in Florida. That's it. That's as simple as the form. Obviously, if there's any other kind of instructions, or you're looking to, have us run it with certain indexes that you like other than the default indexes that every carrier has in their software, you can just put that in the email body, or feel free to write it on here somewhere. That's up to each of you. We turn around designs rather quickly, usually within 24 hours. And then, like I said, we can always make ourselves available to literally walk any of the agents, with or without Doug, whatever he's comfortable with, through the design. And yes, there are numbers of times you got to do it more than once. So that being said, Doug, if you have any questions you'd like me to at least attempt to address, please feel free.
Yeah, Jeffrey, I think right now, that's a great high level of what this program's about. As we start doing more and more of them, I think we probably should, break into some more detailed sessions. But
Sure.
that's great, guys. This is, again, it's not for every one of your clients out there. There is that minimum premium threshold that your client has to be able to come up with. So it's not for everybody, but for the people that it is for, you're gonna get referrals. They're gonna do these IRA deals. They're gonna tell their friends. They're gonna tell their accountants. You're definitely going to get referrals out of this. So it's a great space to learn. Jeffrey, were you saying something?
Yes, I wanted to just touch on one thing you were just saying about it's not necessarily, for everybody, but accountants are a great referral source, but also people who own businesses that want to, for lack of saying it any other way, golden handcuff their top salespeople or their junior partners at a law firm or a doctor's practice also use this, where we have seen they say, I have 5 junior partner attorneys working in my firm, and I love them all, and I don't want them to leave. They're very good. So the firm is going to purchase this on each one of them with however they write up their designs, and we've seen it in dentist's office. We've seen them all do it. They have their legal write it up. And we're purchasing this for you, junior partner, and some of them go as far as saying, as long as you stay with us and until you retire, or some of them are even more broad, or unless you leave the industry and go to as long as you're not going to work for a competitor, we will then sign it over to you as a retirement benefit. If you decide you're going to work for, you're my top salesperson, and we sell those widgets Jeffrey talked about earlier, and now you're going to the other guy who builds widgets who's my main competitor, no, then we keep it. So it's a great source for doing that too. You'd be shocked at how many different organizations do things like that also.
Yeah, and we've got that going on right now with a group. So
that's exactly what I was thinking. I didn't know if that was my place to bring that up, Doug.
Yeah. No, that's great, guys. Give me a call. I'm happy to provide the information that you saw here today. We've got the proposal itself. We've got the complementary illustration that goes with that proposal, so you can kind of see where the numbers come from. We didn't talk about a lot of this stuff that we could have gotten into, like the stress testing and things that are happening out there and things that you need to be concerned about. So
and things like you mentioned, the stress testing. Sorry to interrupt you, Doug, but that will make you understand and as an agent and more comfortable in how we don't just do things only to be conservative, like Doug said about the stress test, which was the second collateral column I showed you, but we do them with a very good explanation as to why it should be done and why most other designers out there do it quite differently than we do. And it gets back to one of the first things I said. We will put our numbers up against anyone, and we have the most accurate numbers out there. And we are even told this by the insurance carriers, that how comfortable they are with our designs.
So let us know, guys. You got a case, you got a prospect that you think this might fit. Again, this was just one carrier. We work with about 4 that have approved this. So give me a call. Let's talk about your case, and let's get Jeffrey on some illustrations. So Jeffrey, we appreciate that today.
Yep.
Appreciate it.
You're welcome, guys. Everybody enjoy. Have a good day.
Thanks, guys.
Bye-bye.
Take care. Bye now.